When contemplating cryptocurrencies, stable isn't typically the initial descriptor that springs to mind. Amidst the tumultuous terrain of digital assets, where prices can soar to the skies or plummet to the depths, stability seems elusive. However, stablecoins emerge as a beacon of relative steadiness in this volatile ecosystem, aiming to provide investors with a sanctuary from the roller coaster ride of Bitcoin and its brethren. Yet recent events, epitomized by the collapse of TerraUSD, have rattled confidence in these supposedly secure digital currencies, prompting a chorus of concerns from global regulators regarding their broader implications for financial stability. So, what exactly are stablecoins, and why do they court controversy? At their core, stablecoins are cryptocurrencies tethered to an underlying asset, most commonly the US dollar, although some are pegged to the euro or even gold. They function akin to casino chips within the realm of crypto, offering traders a bridge between the tangible realm of fiat currencies and the ethereal domain of digital tokens. Investors acquire tokens like Tether or USD Coin, USDC, using real-world dollars, which serve as a medium for trading bitcoins and various other cryptocurrencies. When the need arises to cash out, holders can redeem their stablecoins for an equivalent amount of dollars, ensuring a seamless transition between the crypto and fiat worlds. Glenn Goodman, a seasoned financial journalist turned crypto aficionado, elucidated the pivotal role of stablecoins in the crypto market's ecosystem. Efficiency hinges upon liquidity in any financial market. Robust trading activity ensures smooth operations. However, the cumbersome process of transitioning from fiat currencies like dollars to cryptos presents a significant hurdle. It's costly and often inconvenient. Indeed, stablecoins offer a solution to the time-consuming and costly process of transitioning between fiat currencies and cryptocurrencies. By converting fiat currency into equivalent tokens, users can swiftly and affordably engage in trading activities on exchanges, a game changer for market efficiency. However, recent events, particularly the tumultuous trajectory of TerraUSD UST price, have cast a shadow over the reliability of some stablecoins. The collapse of UST, once touted as a stalwart stablecoin, illustrates the inherent risks within the crypto landscape. Unlike traditional stablecoins backed by fiat currency reserves, UST relied on a convoluted algorithmic framework. When UST deviated from its $1 peg, an algorithm would trigger the creation of new units of a sister coin, Luna, while simultaneously reducing the circulation of UST. The intention was to regulate the supply of the stablecoin and restore its value to $1. However, this mechanism proved insufficient in times of extreme market stress, leading to a catastrophic collapse in UST's value, much to the detriment of consumers and the broader industry. Stablecoins can be broadly categorized into two types: those backed by tangible assets like dollars or treasury bills, and algorithmic stablecoins, which attempt to circumvent the need for extensive collateral. While the latter aims to stabilize the currency through intricate mechanisms, it can exacerbate downward pressure on the associated assets, as witnessed with Luna in the case of UST. In extreme situations, this downward spiral creates a vicious cycle, eroding confidence and precipitating panic-driven sell-offs. The saga of UST underscores the precarious nature of algorithmic stablecoins and raises pertinent questions about the viability of such models in ensuring stability amidst market turbulence. As stakeholders navigate the fallout from UST's collapse, the industry must grapple with the imperative of transparency, robust risk management, and regulatory oversight to safeguard against future crises. The scrutiny surrounding Tether, particularly regarding its ability to maintain its peg to the dollar, has intensified in the wake of recent events. Tether, being the largest stablecoin by market capitalization, has long been dogged by skepticism regarding the adequacy of its reserves to back its claimed value. May witnessed a surge in withdrawals from Tether, surpassing $10 billion as investors grew apprehensive about the token's stability. Central to the concern surrounding Tether is the ambiguity surrounding the source of its reserves, compounded by revelations indicating that its backing may not always adhere to the promised 1-to-1 ratio with cash. The fear looms large. What if a mass redemption of Tether tokens were to occur simultaneously? Such a scenario would likely compel Tether to liquidate its assets, including commercial paper, unsecured, short-term debt issued by companies. The liquidity and value of commercial paper can fluctuate, posing challenges in selling them off swiftly. In response to mounting apprehension, Tether has pledged to bolster its holdings of U.S. Treasury bills, renowned for their safety and liquidity, while concurrently reducing its exposure to commercial paper. However, lingering doubts persist, especially regarding Tether's susceptibility to market manipulation, a contention vehemently refuted by the company. Tether's CTO, Paolo Arduino, emphasized the stablecoin's commitment to maintaining its peg to the dollar, even during recent market fluctuations. Despite temporary dips on some exchanges due to liquidity issues, Tether has consistently honored redemptions at $1. The rapid redemption of over $7 billion within 48 hours, constituting around 10% of its assets, underscores its stability, unprecedented in both stablecoin and traditional banking realms. The UST debacle has sparked regulatory fervor, prompting calls for stringent oversight from governments across the US, UK, and EU. By mid-2022, the stablecoin market had ballooned to over $150 billion. The absence of comprehensive regulation poses significant challenges. Larisa Yarovoya, a finance associate professor at the University of Southampton, advocates for urgent regulatory intervention, citing the ephemeral nature of stablecoins and the inherent difficulty in monitoring their operations. In the UK, proposals to empower the Bank of England to intervene in the event of a systemic failure of a stablecoin underscore the growing recognition of their potential risks. While some economists argue that stablecoins currently lack the systemic significance to trigger a crisis akin to the 2008 financial meltdown, concerns persist regarding the too big to fail scenario as the market burgeons. Drawing parallels to the complexity that led to the Lehman Brothers collapse, there's a consensus among market participants that enhanced regulation is imperative to mitigate risks and foster trust in cryptocurrencies. Improved transparency, auditing, and monitoring mechanisms are touted as vital safeguards to navigate the intricate landscape of digital assets. Ultimately, robust regulation holds the promise of fortifying market integrity, instilling confidence, and averting potential crises in the evolving realm of cryptocurrencies.